Hello and welcome to the Closing Beat, everybody. Happy Monday to you. How you doing out there? Hope all is good and you're having a good week so far. Had a nice long hot weekend. I mean, Jesus, I just stayed inside, Why even bother going outside? Hey, we're financial advisors here at Jazz Wealth, and I hope you check us out at jazzwealth.com. While other advisors are playing checkers, we are playing I used that one already, didn't I? I used that one already. No, we had some really cool stuff happen, ladies. I'm pretty excited. Actually, today we had a client that's accountant was giving them some advice, and I'm like, well, let's take a look and see. Let's look at the actual numbers, and able to lower their tax bill, man. I love that kind of thing. And think about it. What happens after Dave Ramsey? That's what I like to get to. It's like, okay, all that stuff is kind of common sense, put in the discipline, the homework and everything. But what comes after that? How do you do the real geeky stuff that all the rich people get away with? That's what we like to focus on here at Jazz Wealth. And you can check us out at jazzwealth.com. All right, so let's take a look at the stock market. Let's get right into it here today. So far, a weak start to the month of August. Right here is where August started. We got a little bit of a rally today that held, right, compared to Friday, where we had a rally that fell apart there. Now, we've been seeing a lot of news around, hey, August tends to be weak, a weak month, and I thought, well, that's not entirely factual. It depends on how the year plays out going into August, actually. So if we take a look over here, got a little bit of data for you. And we broke it down based on the performance of the market leading up to August, because there's a big difference. In the green line, if the stock market is down year to date, well, then going into August tends to provide at least a bit of a rally, not much by the end of the month, but at least a little bit of a rally. In all other cases, whether the market is up a little or up a lot going into August, that's where you find the weakness. And so when people say, oh, August tends to be weak, just one little extra line in there I think would help to say, when the market's already strong, we go into August and we tend to see underperformance. The dark blue line is when we're up less than 10% year to date. The light blue line is when we're up more than 10% year to date. And so they're kind of the same, right? Where do we stand right now? The light blue line, right? We're up more than 10% year to date. Looking back over the last 40 years, you could see that August really struggles to get anything going. And if you look over here at the S&P so far, it's holding true. It's very early in the month, of course. We haven't gone very far there, but it's very, very early. Add to that a little bit of knowledge here to share with you. The S&P is actually trending ahead of its average. There's something really fun you can do. In the black, we have the average performance over a one-year period. The average performance over 2 years, 5, 10, and 20. Then we look at the stock market now and say, well, how are we performing relative to, this is as of yesterday, performing relative to the average? Well, over a one-year time period, we're just a little ahead of schedule, right? If you're saying, oh, I expect average returns of X, which would be in black, we're just trending a little bit ahead of that. So when you hear people say, like, the stock market's overvalued, it's overpriced, it's extended, it's parabolic, it's climactic, all those things, well, you could add that in there too. We're trending ahead of the average performance. So we're just getting a little bit beyond that and probably shouldn't. Over the 2-year time period, of course, because last year being down, we are trending behind it. So what's that tell you? In the short term, we can have pullbacks. But in the mid to long term, well, we're a little bit behind here over the 2-year time period. Over 5 years, 10 years, longer term investors are like, yeah, we're basically there. But in the ultra short time period, we're just a little ahead of schedule there, right? Now, one thing you may have noticed, if we look at the bond market, ooh, yeah, oh, ugly, right? The bond market is the exact opposite. So if we were to look at the bond market, and I'm going to use the 10-year Treasury using Bank of America's 10-year Treasury Index, and we say, what is the average one-year return? No inflation or anything, just total return. 8.2% in the 10-year. 8.2 for over the 2-year time period. 8.8, basically upper eights as you go into the longer term time period. Where are we trending now? Well, because of this severe pullback that we had right here, as well as back over here off the screen that I can't even show you, because of that, over the 1-year time period, we're severely oversold. We are way behind the average here in terms of return. And that's not for lack of, high yields. We're getting those. It's price. Remember, as yields go up, prices go down. That's like question number 1 on your, financial advisor exam that you got to take. And so in a 1 year, we are drastically underperforming. I shared this in our Notes from Jazz this weekend. It's a weekly email that I do for clients to kind of update them on things and share some geeky stuff as well. We're way behind the average. In the 2-year time period, way behind. 5-year, we're actually way behind still because we're not even trending anywhere near it. And over the long term, way behind. What's that tell you? If you're a contrarian, maybe you like that sort of thing. You know, maybe this is a reason for you to say, oh, prices are cheap, yields are high. Maybe I'll take advantage of a discounted price and the higher yield and be a long-term bond holder. I don't know. I'm just, just things I'm just sharing with you. And also, if you rank that in terms of percentiles, I put this in our Notes from Jazz as well. We are ranking in some of the lowest performance we've seen in the bond market in like generations. So really, really interesting if you're in that bond market. If you're in a target date fund, you're not too happy right now because that bond portion of your target date fund, really, really bad performance. But now trading at a discount. So those of you that need bonds, need to participate in that slower growth, slower yield, higher yield kind of thing. Are you a contrarian? Do you like that sort of thing? What should I do for you? Do you like it? Let's go over to the charts here and take a look. We're going to do something a little different today. We're going to do rapid fire stock technical analysis. And so we're just going to go through some things here. The NASDAQ, of course, pulling back today. 20% of the NASDAQ 100 has gains for the year over 100%. That's not, I'm sorry, 50%. That's not a lot, right? Because it's 20 stocks. So 20 stocks in the NASDAQ 100 have gains of over 50% for the year. There are only 7 stocks in total that are down double digits. The rest of them are positive, right? Very, very cool. Or slightly down, I guess I would say it. Biotech and healthcare are getting the attention here as far as where people are going, oh, maybe I move some money over there. So if you look at things like the XLV or anything biotech related, I don't tend to look over there, but XLV is healthcare in general, one of the better performing sectors, if not the best performing sector here today, right off the 200-day moving average. And that is because Goldman Sachs put out a note that basically said, if we look at the return dispersion by sector, we find that healthcare has the greatest opportunity to offer the highest amount of alpha, which is just outperformance, relative to any other sector. And so they went through and pointed out the sector, they pointed out individual stocks, all this good stuff there. And so that got attention today. You see a lot of those healthcare names higher. Let's do it. Rapid fire by stock here for those that like the technical analysis. Algin, right, falls into that category we were just talking about. A pullback to what's called minor support, if you like that sort of thing. Atlassian would be the same thing. Team is the ticker symbol, same thing. Pull back to what they call minor support there. I'll throw one more in there because I just saw it. IDEX, same thing. So breakout above a series of equal highs and lows, and all of a sudden we've come right back on top of it. What happens today? People say, oh, that's minor support. I might be interested in that. Palo Alto Networks pullback to a longer term uptrend, right? If you did the line here, kind of draw that in there. There you go. That's what the algorithms will look at. Nice little uptrend there. Lululemon. There you go. Possible breakout. So a watch list item there for technical traders. You got a series of equal highs. It is building cause to move higher. Pressure, volume, all that stuff looking good there. So maybe something that happens. Texas Instruments. Actually, Texas Instruments and EA Sports would be one of the more oversold stocks that you could look at. This is a contrarian type play where you say, oh, I fell too far, too fast. Maybe Texas Instruments, if you like semiconductors, oh man, too far, too fast. That sort of thing there, that's not for everybody. And Excel Energy, this is the opposite. Breakdown here, but oversold to the bottom of the downtrend. That's this. So you draw this, you draw that right there. You're oversold now to the downside, but you found minor supports. Minor support because you're in a downtrend there, so it loses a point for that. If we look over at the Dow, Salesforce is your leader year to date, up 60%, even after this pullback. There you go, right in here, still up 60%. Apple comes in second place in the Dow. It's up 37% even after this very much big oversold pullback. That would be one maybe you put on an oversold watch list, or contrarians might like something like that. Microsoft comes in third place, also up about 37% year to date, even after this pullback. Other stocks you may be interested, Walmart. It's a really short-term breakout, right? So Walmart's been doing this, goes up, takes a break for a while, then bam, takes a break for a while, bam. I don't know, maybe something there to take a look at. Doing the stock searching for you here today. Procter & Gamble, same thing here. Possible breakout up near the highs, clear skies above. A lot of people like that. Disney would be the opposite, hinting at breaking down. So it like refuses to participate in anything here, totally out of favor. And although it hasn't done it yet, it is hinting that if we break below that low, all these people here, that just joined in on the stock would technically have losing positions and would likely be in a position of defense, not offense. Nike gets what's called a level 2 breakout. If you're a technical trader, you know and have heard of this stuff here. Level 2 breakout is a consolidation that breaks out but is in a bigger term downtrend. So we're obviously in a longer term downtrend. We've consolidated. Is that the bottom? We don't know, but it's consolidating. If it breaks out, it's just not known to be as strong as the other breakouts. And we move on to Honeywell. It is, I believe, the most oversold in the Dow. And I'm going to go with yes on that one. If you're a contrarian trader there, Honeywell officially ranks as the most oversold. Back to bonds here real quick. So, you know what the real yield is? So a lot of times we'll look, you say, oh, well, the 10 years trading at whatever. It went up again today. But we look at the real yield, meaning what's the total take home after accounting for inflation. And so if you look at the 10-year, it is officially broken out. This would be as of Thursday last week, which you could see on the price chart if you want. The real yield now getting just over 1.8%. In other words, you buy a bond, you subtract the inflation, right? Current inflation, and you end up with 1.8%. So that's nearing 2%, right? So you're actually making a profit for doing this instead of like it's been for, I don't know, 5-10 years or so, where you buy a bond and at the end of the day, you lost money to inflation. We don't have that sort of thing. So I will ask you a question. Is now the time to get long-term bullish in the stock market? And if so, how would you convince me to do that? Say I came to you, I said, here's $1 million, right? Tell me whether we should be in the market long-term now, or should I be a little bit more spotty, selective, maybe stock picker-ish, build the portfolio over time that may track the S&P, but I'm just going to pick at it for now. Why would we do one versus the other? Well, there's lots of different reasons. You can use fundamental analysis for that. You can use technical analysis. You could use a combination of both of those where you say, we're in a long-term uptrend, we're pulling back, I'm interested in buying that pullback, any and all pullbacks, but I don't want to commit to things right now. Certainly an answer. You could also look a little bit further into what's known as the Economic Indicator Index. This is something that is tracked by the big boys. It's not a primary indicator, but certainly something you want to take a look at. What they do is, instead of tracking every single economic indicator, inflation, core inflation, producer price index, home sales, residential home starts, multifamily home starts, looking at the jobs numbers, unemployment, continuing jobless claims, there's something every day, right? What was today? Retail something or other? So today, consumer credit, and you're like, okay, what do I got to follow here? Instead of doing that, you could build an index of all the different economic indicators. And you could equally weight them, or you could assign them more power based on the impact that they have on the market. That's typically what's done. And then you have basically one thing to look at that encompasses everything. And if you did that, then you could say, well, show me the number of them going up. In other words, show me the number of economic news events that are doing better than expected. Sometimes going lower is better than expected, like the unemployment rate, et cetera. But you could say, if the majority of them are going up, maybe that's a good sign for the market. If all of them are going up, maybe things are getting a little overheated, right? Or you could say things are good. If the majority of them are going down, so well, things don't look so good. Economic indications that are out there are not meeting expectations. Wow, we're performing under what a typical economic growth profile would look like. Let's take a look. So here's a little bit of a history going back to 2000. This is literally the day I graduated high school. So we go all the way back here and we say, well, just show me the numbers. Look back over here. late 2020, early 2021. The majority of them were showing better than expected. Well, that's to be expected. That was actually a record, and that's only because we came out of COVID. We had next to dismal numbers back over here where all of them were showing worse because everybody was revising down. I get that, right? Major international crisis. Okay, fine. But if you look around, you say, well, when everything's trending higher, what tends to happen following that? Oh, pullback. That's interesting. Let's look back over here. What tends to happen when things are strong? Oh, wow, pullbacks inside of a bigger uptrend. Not that the world is collapsing. That already happened through the financial crisis, right? But you look at when things get overheated, well, it tends to mean that the market needs to take a break. The economy is doing so well that people are paying too high a price for stocks and for indices and for mutual funds and everything, so we tend to see a pullback. If all you did was look and said, anytime that the economic indices trade below average, I'll use that as a buying opportunity. You'd actually beat the market over this exact same time period if that's all you did. You don't even have to be right within a 6-month window. That's how much time you have, because this is not every day, right? These are different numbers come out every day. Well, where we stand right now is 3 more economic indicators are trending lower or missing expectations relative to those that are beating. Is that good or bad? I don't know. I'll be honest with you. It's sort of like the glass is half full and half empty at the same time. We could argue which one is which. It's a little bit more half empty in this case, but it's not trending lower, it's trending higher. So things are looking better. So I would argue that this is like the perfect moment to suggest, if you think this continues, that when the market pulls back, it's more of an opportunity than a fear factor. And we don't have much of a pullback at the moment to work with, but just saying, when you look at that, it's, well, things are generally trending higher. Maybe a handful of things still weaker, but that's okay, right? So you have an argument to buy pullbacks. You don't have an argument here to say, oh, we are well below average, everybody's sort of fearful, and the VIX is higher, and, you know, oh my God, unemployment's rising and all that. We don't have that. Kind of right in the middle. So it's a really, really weird time to suggest that you should be 100% in the market. And I spent a little bit more time on some different things here today. So I will go through quickly I will go quickly through the stocks in the news here, and then I'll take your questions. If you happen to have any questions, we can do that there. Okay, let's go over here. Okay. Oops, I typed the wrong thing. There we go. Okay, first up, you got Campbell's Soup. They're buying, what was it, Rouse pasta? Was that the one they were buying? Yeah, Rouse pasta sauce. 23 bucks a share. So anytime a company buys something from another company, stock price tends to take a hit in the short term. I just thought it was interesting because this is a new breakdown that is not extended. So maybe a little bit more weakness ahead there because it's just getting started. American Airlines, there was a handful of upgrades and downgrades today. For every downgrade, there was an upgrade, so it's kind of a wash. American Airlines fell into the mix of all that kind of chaos today. American Airlines up 1%. Obviously, it's pulled back into the top of the uptrend, the longer-term uptrend there, so maybe something interesting. I thought, well, hey, I'll go look at the rest of the airlines as well. They also fell into the trap of all the upgrades and downgrades. Hey, you know, you get what you get there, right? Berkshire Hathaway hits all-time highs there. Warren Buffett has more cash on hand than, I believe, almost ever. I think he's had more than $150 billion at one point. It's been a long track record, obviously. But the stock hitting new highs because despite having higher cash, they have higher earnings. So good for them. Very good. Tyson, there we go. Spent a little time on this one here today. Oh, ultimately it finished only down about 4%. Earnings were just weak across the board, really weak. Beef, chicken, prepared foods, that's all they got. 1, 2, 3. Yeah, they just, no, not even a chance of beating there. Beef prices were up 5%. Pork prices were down 16%. They could capitalize on that. Chicken prices down 5%. I don't think I've realized that those prices have dropped, so I'm not sure what prices they're looking at. And they're closing 4 chicken plants that produce the chicken in Arkansas, Indianapolis, and somewhere else. And you know why they're doing that? They're not trying to be mean people and just put people out of work. They're closing those plants, and it'll be temporary. But they're closing those plants because why? If your earnings are horrible and you have no other way to get earnings to show better margin or to have better profit margins, what do? You get nimble. You close the most costly plants that you have, and voila, your next earnings report will show higher margins. Would you do the same thing if you were the CEO? You got shareholders yelling at you. You're like, well, I don't have an exact answer. Food prices are volatile right now. But if we close those 4 plants and then we take that off of our books, all of a sudden we have better profit margins. I think that's a no-brainer. Anyways, join us for the podcast. It's actually up on the old YouTubes there. We talked about portfolio construction, the efficient frontier, and kind of messing around with that from a very basic level, but kind of showing visually what that looks like. If you want to check that out, it's on our channel and it is live. Tomorrow you have Capri, fancy. Expeditors, a couple other transports, I believe. Well, UPS will report in the morning. Under Armour, and then after hours, you got Barry Diller's Interactive Corp, Rivian, Toast, and Twilio. Yeah, and Rivian ties with Twilio for being the worst performer. Only 2 out of the last 8 positive. And actually, Rivian would be worse because it doesn't have 8 earnings reports. So 2 of the last 6. Yeah. All right, I'll take your questions if you have any questions, and then I will get out of your... Cody's got a question.
You want to announce our winner?
Oh, you got the winner.
Yeah.
Oh, there's the winner. Go ahead.
Yeah. We got it's not Eloy. I know it's not pronounced Eloy, but that's just the only way I remember how to pronounce that name.
How do you think you pronounce it?
We've gone over this before. I think it's Elaw, but
oh,
yeah, I don't remember how to pronounce his name, but I did email him. He's in the chat today, so good for him. Congrats!
Congratulations!
Congrats to him on winning $100.
Yeah, and what'd you choose, Eloy?
He's good the gift card.
Oh, he's going with the gift card. Good choice. Good choice.
Yeah.
Eloy, tell us, man. How do we say your name? I don't want to say your name wrong.
We've done this before. I swear we've done it before with him.
I know.
Elaw.
Okay, close. Sorry.
So.
Well, that doesn't help. He's Canadian, so what does that mean?
Yeah.
Oh, that's why it's Eloy.
Oh, it's French.
French Canadian?
It's got to be.
He's about to leave the chat. Well, congratulations, man. I love that. That's awesome. So that is our our winner of Guess the Dow. If you want to play, go to jazzwealth.com/Guess the Dow. You don't have to be a client. If you're not a client, you get the gift card. If you are a client, you can choose to have me credit your Roth IRA. That's the hint. Or you could take the gift card. Nate says he expects bigger than a 5% pullback because of the Fed uncertainty. Well, we're working on it. Yeah. Yeah. Corporations will step in and take the opportunity to raise prices again, especially in the airline industry. There is no shortage. And cruises, I'll say cruises too. They have not had to be flexible on their pricing. Yep. Apple's a great example of when a stock goes up for too long without pulling back, the pullbacks tend to look just like you see. I don't know how else to say that, but a stock doesn't like to go in one direction forever. It needs this, a healthy trend, right? People that are fearful and greedy. When everybody's just happy, how can it be that every day gets just a little bit better? Not a lot better, not a lot worse, just a little bit better. And when you have these little pullbacks, they're not bad. They're just tiny little pullbacks. They look bigger, but look where they closed each day. These are just minimal little pullbacks. So when that happens, after some point, when people pull the plug, that's it. It's essentially pulling the plug. Yeah. Where do we find the economic indicator index? Yahoo, maybe? You could probably use Yahoo. You could build one too. If there's any, I don't know what you use to, like, if you want to build like a mock portfolio and look at its performance, you could do that and just add the indicators instead. Yeah. Utilities starting to get cheap there. I wonder why. Yeah. And that's the same. There's a lot that looks like this. This is what makes you kind of a little bit cautious about the broad market. There's a lot of stocks and a lot of sectors that look just like this, on the verge of just sort of getting really weak, breaking below areas that we haven't seen in a while. And when you see that over and over and over again, you think, well, how can it be? Well, I see the big names besides Apple were higher today, but doesn't that make it just a little bit cautious? Yeah. Eloy. Eloy. That's how you say it. Right? Is that what you got? Yeah. I missed the question on something about Apple and Berkshire, but it seems like somebody got you there. I went over a lot of stocks the other day, but we went over DFLI, and you say I don't know. Oh, somebody asked something about that. I was including it in a scan of the worst performing stocks year to date, but that had better performance in the short term. I think that's what it was. Eloy. I like that. That's a sweet name. Eloy. That's good stuff. I like it. All right. Well, thank you for that. Planetary earnings were out. I did catch the beat there. I did not catch the details of the beat. And a slight little bump for them, 18 or so. It's going to be tough to say that that should have a rally of 10% because of earnings. There's so much priced into that stock. So a little bit tough there. Yeah. Oh, yeah. All right, cool. Well, looks like we've wrapped it up there, and we'll wrap it up for today as well. And I'll be back tomorrow, and of course, the rest of the week. So if you have any questions or want to come learn some more, you know where to find us. Enjoy, and thanks for hanging out with us. Adios.